Good morning, everyone,
Morning.
and welcome to our DAT IQ weekly market update. This is our update for February 1st, 2022. I'm Ken Adamo, Chief of Analytics here at DAT, joined by Ned Damon, who's our Principal Data Scientist, and Dean Croak, who is our Principal Industry Analyst. Good morning, gentlemen.
Good morning.
Good morning.
Yeah.
So, did you dig out up there in Boston, Dean?
We did. It was pretty easy, Ken. It was we had about 5 feet of drifting snow around the house and about 2 foot net, but it was light, fluffy snow, so a bit of a shoulder shrug for most of us New Englanders.
Didn't you get a flamethrower last year for melting the snow?
I did. I haven't had enough ice, although this morning it was a bit slippery. I might bring that out a bit later today and see if I can melt the driveway.
Well, us in the Midwest proper here are bracing for Landon, which we'll touch on here in a minute. So anywhere from an inch of ice up to 2 feet of snow should be a regular old hoot. All right, so with that, we got a lot to cover this week. I will put the call out early for questions. So if you have any questions, thoughts, or comments, just drop that into the chat below. Our diligent marketing team will get those over to us to answer towards the end. So with that, let's go to our key points of the week. So spot rates, seasonally, facing some downward pressures. Not as much as in years past. If you remember last year, January was pretty much fell like a rock, and then we had that mid-February polar vortex that really spun things up. We've just been having weather event after weather event after weather event so far this year, so they haven't had a chance to really ease back all that much. Load board volumes down, U.S. Bank Freight Index down. Those flowers mainly coming from Ecuador, I believe. Dean can check me on that when he hops on the market update. We'll be shipping for Valentine's Day. Dean talked about Winter Storm Garrett. We also have Landon barreling down. And although I am a transplant to the Buckeye State, we choose not to recognize Buckeye Chuck and instead focus on Punxsutawney Phil, who will be making his illustrious prediction tomorrow, I believe, on whether or not spring's around the corner or we have 6 more weeks of winter. So with that, I will turn it over to Dean for the market update.
Let's start off with our load-to-truck ratio in dry van. Load post volumes down for the 3rd week in a row, down about 20% in the last month. Carrier equipment post increase, so more carriers returning to the market. So as a result of that movement, the load-to-truck ratio dropped to 7.63. And in the refrigerated sector, they've been dropping for about 4 weeks in a row, following last week's 14% week-over-week decrease. Load posts in the reefer market are still about double where they were this time last year, but down 40% month over month. So more carriers came back to the market last week in the reefer sector. So the load to truck ratio also went down to 14.35. And in flatbed, a little bit of a difference there. The market's sort of behaving as it would normally behave in winter. It's a hard time for flatbed carriers. Everything freezes up. Straps, tarps, everything's frozen. It's hard to work outdoors. The capacity generally tightens when that weather gets a little bit colder. Last week's load post volumes were up 1%. Spot rates were up also, as we'll cover a little bit later. So as a result of that movement, with more equipment posts and higher load post volumes, the load to truck ratio dropped to 84.91. Having a look at our market condition index map across the country, following up from last week's show where Chuck Snow, CEO of Traffics, was on, he talked about the impact of the protests in Canada and the imbalance of freight and trucks cross-border. A lot of trucks that head into the US from Canada will want to load back midweek. And what we've seen already is that there's a decrease in capacity in some key markets as a result of carriers or drivers in particular, who won't or couldn't cross the border into the US. One of the big movers this week in spot rates is what we call Auto Alley, that connects Mexico and Canada. A lot of you will know that there's a lot of Canadian auto parts manufacturers that have a lot of plants in Mexico. There's something like 30,000 components that go into making a car, and a lot of those parts move back and forward between the 3 countries. So on the southern border this week, there was some spot market activity for loads north into Canada. In particular, out of Texas to Toronto, load spot rates surged to $2.56 a mile today. That's what they're averaging. That's about $1 a mile higher than the average of all of last year. That's dry van Texas to Toronto. A little bit more impact on the East Coast in Elizabeth, New Jersey. Elizabeth to Toronto, a lot more volatility. Spot rates are averaging $3.05. That's excluding fuel. That's up 84 cents a mile in the last 4 weeks, and also about $1 a mile higher than the average of 2021. So lots of volatility there on those northbound lanes. In refrigerated, as Ken mentioned, it's Valentine's Day, so a lot of brokers and carriers are positioning themselves ahead of the demand. Peak shipping week is this week, and then next week, load post volumes out of Miami are up 15%. About 70% of all the roses and carnation stems come in from Colombia and Ecuador. A lot of them land in Miami before being trucked all over the US and into Canada. The number one reefer lane is Miami, Los Angeles. Spot rates are averaging only $1.20 per mile, but that's 8 cents a mile higher than both December and the corresponding week last year. So capacity relatively loose on that lane. A bit different story, northbound to Atlanta out of Miami. That's the number 2 destination for loads. Capacity tightened this week. Late rates are about $2.35 per mile. That's about a 52 cents a mile increase over last month. Spot rates this time last year were about $1.70. And the number 3 lane is Miami to Elizabeth, New Jersey. Spot rates are averaging $2.15. That's up 55 cents a mile year over year. So having a look at our market condition index for MCI, I took a look at the Baker Hughes rig count, the number of drilling rigs across the country, 60% higher than this time last year at 604. That's oil and gas combined. About 50% of the oil fields are in the West Texas Permian Basin. We see a lot of flatbed volume of pipe and casing heading from Houston to Lubbock. But rates have been fairly flat at around $2.90 a mile for the last 3 months, although they are still about 73 cents a mile higher year over year. Loads north to the home of the West Texas Intermediate oil spot price, Oklahoma City averaging $2.71 this week. That's up 67 cents a mile year over year. And spot rates to Bismarck, North Dakota, home to the Bacon oil field at $3.02. That's $1.17 a mile higher than this time last year. And on our benchmark lane, our number 1 lane for flatbed loads between Houston and Fort Worth increased 9% week over week, making it 4 successive weeks of gains, although capacity continues to ease. Spot rates down to $2.78. And wrapping up with our year-over-year look at spot rates, more seasonality emerged last week, as Ken spoke about at the top of the show. Rates were down for the second week in a row, decreasing by just over 3 cents a mile to a national average line haul rate of $2.73. Now down 5 cents a mile in the last 2 weeks, but still 69 cents a mile higher than the same week last year. In the refrigerated sector, after being flat for most of January, spot rates recorded their largest weekly drop so far this year, down 5 cents a mile to $3.11, still 87 cents a mile higher than this time last year. And flatbed spot rates have been just that, flat for all of January, averaging $2.66 a mile. That's excluding fuel, as they did most of last year, up a penny a mile 1 week, down the next. National average is currently 46 cents a mile higher than the same period last year, and about 70 cents a mile higher than the same week in 2018. So that's it for this week's market update. If you'd like to find out more about what's happening in freight, go to dat.com/market update and download our weekly report. Over to you, Ned, for the short and long-term forecasts.
Hello, everybody. We're going to start off with our dry van forecast. You can see in blue the market rates observed by DAT, and then off to the right you can see our forecast models. In green, our rate cast models expecting the current downward slide to continue for the next 2 weeks, dropping by about 3 to 4 cents before it ticks back up, landing us about the same amount above the current position in the later part of February. In contrast, our short-term model agrees with the rate cast model up through about Valentine's Day, and then expects after Valentine's Day the slide to continue with a little bit of a dip. I think that's around President's Day, heading down, dropping about 5 cents over the entire period. In gold and silver are our 2 forecasts, blended forecasts, which are mixtures of the 2 models in different amounts and in different ways. And because both the models agree during the early part of February, they're tending to agree with both of those models. As we get into the later part of February, they're leaning a little bit more towards the short-term model. But I'll be interested to see how that's going to play out. Next up on reefer, once again, we have in blue the market rates observed by DAT. And then off to the right, you can see our forecast. There's a little bit less agreement here. The short-term model is in red, is expecting rates to continue more or less flat with maybe a little bit of upward traversal by about 5 cents over the next month, although it's a pretty bumpy ride. Ratecast in green is expecting rates to drop by about 5 cents and then return to about where they are now, maybe a little bit above over the next month. And our gold and silver blended forecasts are leaning more towards the ratecast model during this period. Finally, moving into flatbed, once again, you can see in blue the market rates observed by DAT. And then off the right, you can see our forecast models. Here we have extreme model agreement through the first 2 weeks, which I kind of love to see, of nice and flat. But then once we're heading a little past Valentine's Day, RateCast is expecting rates to take off quite strongly, an increase of about 7 to 8 cents over the period. And RateCast is in green. Our short-term model is expecting a continued flat trend with that bump again for President's Day. And then the gold and silver models are leaning more towards the short-term model with a little bit of growth into the later part of the month. And this week we have a special treat. We're going to be going through our long-term forecasts. So for long-time watchers of the show, we occasionally go through the long-term forecast models that we make that these are all rate casts. So the short-term model doesn't make any sense as a long-term model. So instead, we're looking at a couple of different rate cast scenarios. We're going to start off with dry van. This chart is actually a little bit tricky to read, so I'll go through it. The line in blue represents the actual observed spot rates by DAT, and that's red against the left axis. The shaded region in gray is the variance to the prior year, and that above or below the line is the right axis, and that's expressed in terms of percent. Finally, once we get to the end of the historical period and we move into the forecast area, you can see our RateCast forecast in blue. The blue dots are the central point of the RateCast forecast. And then we have our high and our low confidence bands for RateCast. So what you can think of the red dot as being a kind of bear market perspective and the green dots as being kind of the bull market perspective, with RateCast being in the center. If we calibrate properly, the majority of observed occurrences will fall within the band. So let's talk about this. Looks like RateCast in and of itself is expecting rates to be trending upwards through the period. Actually, that's a very, very strong growth, and it'll be interesting to see. We're going to talk about this a little bit more once we get to the bottom part of the show, but that's a pretty aggressive prediction from RateCast. Moving on to reefer, once again, you can see in blue the market rates observed by DAT against the left axis. You can see the year-over-year variance in the shaded region plotted against the right axis. And then you can see the forecast models. Here, the bands are a bit tighter, which I appreciate, but there's still a lot of upward traversal that the models are expecting. The core RateCast model is expecting growth of, looks to be about 20, 30 cents over the next year, which is very aggressive, and it'll be interesting to see that play out. The green dots are our bull market case, and the red dots are our bear market case, with the bull market case having extremely strong growth and our bear market case having things drop a little bit in the early part of the year and then basically maintain current levels with a little bit of overall growth of just a couple of cents. Finally, moving into flatbed, once again, we can see in blue the market rates observed by DAT. The gray against the left axis, the gray shaded region is the year-over-year variance expressed against the right axis. And then our forecast models. Here, the bands are very tight initially, but then they rapidly expand, which makes sense given the way that the flatbed market behaves. And here you can see actual pretty broad model disagreement about the overall trajectory. I think there's overall agreement between the bull, the bear, and the flat, the neutral case, I should say, rather than flat, that there's going to be some a little bit of a turning, either flattening or dropping pretty aggressively as we head into the later part of the year, but they differ strongly on how much growth potential there is in the early part of the year. And with that, it's time for me to stop talking about them and instead to bring in our more market-savvy colleagues. So our DAT IQ question of the week is, what's the long-term outlook for spot rates?
I think you pretty much covered it. We can go home and grab some coffee.
Sorry. I didn't want to just throw the charts up there with no commentary.
Yeah. No, I think we haven't pulled those in a while. I think it's been like 8 or 10 weeks. Just I could judge because each week is a row in the file, and I was playing around. Right. RateCast pretty much across the three equipment types. I mean, the flatbed not as much. Pretty much tracked to that upper green line since we last spoke about this, right? It's pretty much been bounded by that upper end prediction, which makes sense, right? The upper lower limits, as you mentioned, are expressions of our historical error rate.
Right. Yes.
So it only makes sense that they would sort of like ping pong between those lines.
Assuming that we calibrate well, it should stay most of the time within those lines. If it goes outside of those lines, that's a signal that something is going on, and I need to go open up the hood. If following the upper bound, though, I think is actual information. Like, I think all of us going into January, we're expecting standard January seasonal rules to apply and the market to cool off a fair bit, and we just haven't really seen it.
Yeah. It's been 3 weeks of weather, Ned. It's played an impact on regional markets. Another storm this week's likely to throw another wrench in the works. So eerily similar to the impact of the polar vortex a year ago this month, but I don't know that it'll be that severe across so much of the country. But weather's certainly playing a role regionally. Yeah, exactly. Sub-zero temperatures, freezing temps in Texas this week. So not
Florida
really,
too.
Yeah, exactly.
Northern Florida.
Yeah.
Yeah, I mean, as these weather events become more prevalent, whether it's hurricanes in the summer or tornadoes, and then these winter events. I mean, it's just, I think, as we adjusted to the return curve, right, and the return curve being, it used to drop off after Christmas like a rock, but with e-commerce and all the returns, we had to get used to building in a couple-week buffer. It may be prudent moving forward to just sort of build in some uncertainty into January and early February for these becoming more, I'd like to say freak weather events, but if they're happening every year,
they're not. Yeah.
They're not freak.
Yeah.
I think something that I was talking with Dean about early on the show, normally when rates are this high for this long, you see huge flushes of capacity into the system to kind of drive the market down. There's a lot of folks trying to catch. And, Dean was saying that we have seen that, but I feel like we haven't seen that as much as we saw in like the later part of 18. Where like everybody just went ham, and I think that's partially about just not having enough equipment. But I don't know.
Well, the other thing that is that trucks are running fewer miles because they're earning more revenue per mile. They're being held up longer on loading docks. You've got more weather delays. Anecdotally, I know a lot of carriers who've taken more time off this year because they had such a great 2021 financially. So they've taken more time getting back into the market. So there's some sort of constraints on capacity that we don't normally see. At the moment, inability of large fleets to buy a lot of new trucks because of the supply chain issues at the factory level. There's some things that are going on again this year that are impacting rates that we wouldn't normally see in a typical January.
Yeah, and I think deadhead miles is another story. Sorry, Ken, for cutting you off. Go ahead.
No, I was just going to. I mean, I think if you could walk down to your average Freightliner or Kenworth dealer and buy 10 trucks, you would.
Right.
Especially now. I mean, I think the Fed's been pretty transparent to the extent that they're transparent. There's going to at least be 3 rate increases this year, interest rate increases. So, it's going to start to become, the truck prices are already up due to inflation. And sure, right, the reason you raise interest rates is to try to quell inflation, but those things don't happen one right after the other, right? It's you're changing the trajectory of a large ship. So yeah, I mean, you could be caught in that middle point this year, probably where interest rates are high, truck availability is still low, and truck prices are still high, which is a less than optimal formula.
Yeah. And I think in general that a lot of the licensing constraints in terms of drug testing and so forth on new entrants into the marketplace is making it not, as much of a new carrier growth as we might expect to see. But
yeah, I mean, if you really want to kind of get into the mechanics of it, it's almost like the scarcity of capacity. And what I mean by that is like tangible new capacity, new capital capacity, capitalized capacity, is almost creating a monopolistic effect of the carriers that are in the game.
Yeah.
Right. So the market is unable to exert its downward pressure on prices because new entrants are prohibited, much in the way a patent would protect a firm or a government-regulated monopoly. The market, the scarcity of resources, preventing these new carriers from entering and driving the prices down.
Yeah.
Now, I don't think it's preventing the outstripping of demand from the market, which we're seeing that happen. All of the credible freight indices or load board activity are showing more demand shifting from spot to contract. So that's going to happen. But what people are used to seeing is the double whammy effect of demand shifting, capacity coming, and then you're moving twice as fast. Think about it, right? So if we lose five percentage points of demand and add 5 percentage points of capacity, the market moves 10%, as opposed to, you know what I mean? So it's something to keep an eye on, for sure.
Is it time to move on to listener questions?
Yeah, we only have one this morning. I think people might be getting ready and salting their driveways. And I was driving in this morning, and they had 3 front-end loaders clearing the berms.
Right.
Getting ready.
We were up. We had front-end loaders and bobcats, skid steers, dump trucks cleaning our streets last night all around Boston. One of the fascinating things with dump truck carriers is they haul salt and then to treat the roads, and then they haul snow away from these massive snow piles that build up all around town. So they've been up busy all night trying to get rid of the snow before this storm comes in.
Yeah.
Before we got into the listener questions, we did have an email listener question. Somebody asked me to show some calibration plots for ratecast forecasts, and I'm saying I'm answering you on the show, and you also got an email. We are absolutely going to do that soon. It's just a matter of squeezing it into the schedule.
The corn cobs. I know a couple people. I know our good friends at Circle Logistics, the corn cobs as well. I just it's been a little busy around these parts. As I think I mentioned, we're growing, right? So we're hiring our department, I should say. We have 14 open positions to fill this year. So it's been, to use monopolizing a second time, it's been monopolizing my time. And I've been unable to focus on the corn cobs. But we'll get to them. Honestly, it's going to take a minute. We got to pull it. We got to look at it, make sure that it's pulling in all the right data. We added a new use case since we last ran them, right? Which is a 3-day, the 3-day rate prediction. So we'll try to get it before next show.
All right. Gary Bates asks, how do brokers find shippers on DAT? That's a good question.
Find shippers.
Yeah. I mean, we don't really have I'm sure that the sales and marketing people are going to be all over me, but we don't really have a tool right now to help you find shippers as a broker. And I think that that's something that
kind of on purpose. So it's not really our. Yeah, I'd have to think about that one. We don't, unless you're a very small shipper, you're by and large not super active on any of our freight matching products, right? Yeah. And what I mean by super small is like you're not large enough to have a contingency of core carriers. So in that regard, you might be out there. Like we have lane makers. That's a tool. I guess in theory, you could look at load posts on a given lane in lane makers, and if a shipper popped up, you could call them, but that's going to be dominated 99% by brokers. I think you'd have to get way down. You probably have to buy some custom data analytics from Alex Perry. Actually, that's the answer to all questions that stump us on the show. Contact Alex Perry. He will, if it exists in our database of 12 plus years, he will find it for you and sell it to you for a very reasonable amount of money. But short of that, we're really in the business in helping brokers find trucks, helping trucks find loads, helping shippers understand their costs and find new carriers. I don't know that we've ever really broached the topic of helping brokers find shippers.
I mean, to go into deep weeds, a couple of years ago, I actually had a conversation with some of the folks at the front desk about trying to build a tool to help new brokers find shippers and like an instructional program for, because there's a lot of new brokers that do sign up and they have trouble finding shippers, and it's somewhere in the
think about it too, right?
DAT.
I mean, if you're a broker on our load board, you have to be assured that the information about your shipper would never be disclosed, because then it's open season on your shipper, right? That's the reason why we kind of had that reaction about your question, Gary, is that that's a very closely held piece of information by most brokers, right? They don't want their customer list getting out. No business does, regardless if you're in trucking or insurance. You wouldn't, if you're an insurance broker, you wouldn't want all of your big clients posted out there on the internet. for other insurance brokers to go after. So that's just an idea of how the mechanics work, right? Of how a broker is interacting with us. If that makes sense.
Yep.
We have a question from Spire Lazarowski. Do you think that monetary policy response to inflation will influence the freight price in reefer van or flatbed? I mean, to use Ken's analogy, it's a real slow ship, right? Like, the goal of raising the interest rate is to drop inflation by cooling demand. And so cooling demand is going to, all things held equal, going to tend to drive down rates because there's less goods moving around.
Right.
Well,
well, okay, all right. I'm interested in this. Okay.
I think the question's really around the supply side economics, right?
Okay.
And over the long arc of time, so long run economic analysis would have you indicate that the cost to move freight, the supply, the willingness to supply is driven by the carrier's underlying cost structure. And there are a few big key components to that underlying cost structure. The overwhelmingly dominant portion of that, Dean, is your truck payment, right?
Mm-hmm. Yep.
Your fixed costs, right? Whether you run a mile or you don't, the bills come in. So you have your fixed costs are your truck payment, your insurance, maybe some permitting and stuff like that. But I can't think of any other major fixed costs besides your truck payment and your insurance.
Yep, you got it.
So with your truck payment, you have principal and interest. The only monetary policy that the Fed's really going to be able to play with here to quell inflation is going to be rising interest rates. So if you already have your truck and you're already locked in, as long as you're not on some kind of sliding interest rate loan, you're okay. But as we know, there's hundreds of thousands of trucks on back order, or will be, right? Those are going to get financed under the new rate regime. So therefore, you're going to have a higher fixed cost. So short term, the market doesn't care what your costs are. Long term, it does. So I would say that, yeah, this period, if we see 5, 6, 7% prime rates, which again, that we're a long way away from that. That is almost alarmist at that point. But if we see a 7, 8, 9%, then you start to see, yeah, that it will greatly impact everything, not just freight rates. That is sort of the inflation and interest rates put this, unless you're an all cash under the mattress kind of person that's only buying from cash-based suppliers at farmers markets, you are subject to inflation and interest rates in all facets of your life, right? You'd have to live in a paid-off home with a paid-off car, only deal in cash with cash-based suppliers to sort of be insulated from that, and no one really is.
We had a whole bunch of questions come in. Is it all right if we run along, folks?
Yeah, sure. We're still early, actually.
Yeah. Austin Allen asks, are there more 26-foot loads being moved due to LTL common carrier volatility?
Yeah, we're actually having an expert on this month to talk about kind of partial, the lowercase LTL side, right? Sprinter vans, box trucks. Absolutely. We had, from Pitt, Ohio, Dean, help me out.
Gosh.
I'm horrible with names. I don't remember my kid's name half the time.
Yeah.
But yeah, I mean, it's really going to hit in the volume sector, right? I mean, I think he mentioned they flat out aren't accepting volume from all but their huge carriers. And when I say volume, I mean like the big shipments. They all have their cutoffs. It could be 8,000 pounds. It could be 6,000 pounds. It could be 10,000 pounds. Right now, given where truckload rates are, if there was unlimited LTL capacity, you'd be pushing 12, 13, 14,000 pound shipments on LTL. No questions asked. They're just right now not accepting it, or they're upcharging that volume to a point where it doesn't make sense. And keep in mind, over the last 10 years, LTL carriers have greatly shifted their line haul networks away from company assets to intermodal and what they call purchase transportation. And so they're out there buying transportation alongside you. So keep that in mind. That's why you're seeing a lot of these constraints. And yeah, if you have a 26-foot straight truck, 28-foot straight truck with a tag axle, you're in the driver's seat right now, if you pardon the horrible pun. Right? You're probably garnering full truckload rates from a year and a half ago, truthfully.
All right. Next question is from David Miller. When do you expect to see more activities with the electric trucks?
Oh, show me how many trucks right now, Dean, Class 8 trucks are licensed to operate as commercial vehicles in the United States? Order of magnitude, not a specific number.
I've got no idea.
Is it hundreds of thousands or millions?
It's millions. I just can't recall the exact number. 5 million comes to mind, but I'd have to dig that up, do some more research.
Right. So maybe when we get to 10% of that, which would be what? 500,000 electric trucks out there, which means you'd see them every day on your commute. You'd interact with them. You'd notice them on the highway. That's probably when we're going to see an impact. Yeah. I know it seems like we're downplaying, like we're like yellow cab on this show because we're always talking about like waving our stick at the air about our cane about how this is never going to change. We're not saying it's never going to change. It's just like you have to see it happening to understand it when you're on the precipice of change. It's like you're not going to wake up one day reading the newspaper and all of a sudden there's 1 million electric trucks on the road.
Yeah,
just like how long did it take before you noticed Teslas in your local parking garage? You didn't just wake up one morning. Like it used to be your rich techie neighbor down the road had a Tesla and everyone was like oohing and awing over it. And years later, you see them everywhere. It's probably going to be the same with trucks, but we're not even in that rich neighbor down the street having a Model S or whatever one of the first ones was called.
Don't they take a lot more semiconductor chips to make also? Not to mention the cost. Yeah.
I've never even seen one. I mean, I live in Ohio, but I live near 2 giant east-west corridors of I-90 and I-80.
Yeah.
And I-76, I guess, to an extent. But so we'll see. I think they will eventually have an impact. I just don't think we're like right there. Like they're just waiting, waiting to take over everything.
Can I do like math? Sorry, can I do math soapbox for 1 second? So like some things grow exponentially where the thing makes more of itself, and they're like as soon as you notice it, it is basically already too late, right? Like when your neighbor down the street has a thing that grows exponentially, it like a month or 2 from now, whatever the doubling time is, then you're going to see it. Trucks don't work like that. Trucks grow very linearly. Like there's a lot of existing equipment. There's a lot of existing capital. People aren't just going to immediately scrap them unless there's some kind of like a bizarre government mandate about that. Things are just going to get this nice linear growth curve of stuff getting replaced. And so you don't need to try and look way far down the road because like 3-4 years down the road at a linear growth trend, that's plenty of time to react. The time when you have to like really have your feelers out and really be sensing is when things grow exponentially, and trucks do not make more trucks. So yeah, sorry.
Now, I think you make a good point, Ned, because I do think like when you see, not to pick on anyone in particular, I'm just pulling a random name out of a hat. If Schneider, has half their fleet or a quarter of their fleet running electric, and Swift has a quarter of their fleet running electric, or even 10% of their fleet's running electric. And it's mostly going to be P&D and short haul and zone skips and stuff at first until the battery tech catches up, right? Because, I mean, there's a lot of brokers listening to the show. How happy is your shipper going to be when you tell them that you're going to have a service failure because they couldn't find a charging station and they had to go find, and now they're laying down? Or the charging didn't line up with their break, right? They ran their hours and now they got a break and that's not going to line up with their charging. Or what about the hours of service exemptions? What if they have to get out of their bunk and break their bed card rules to go unplug and move their truck out of the charging station? I mean, there's things like you need to think about because it's not as easy as pulling up to a TA, topping off your tanks with diesel. I mean, talking as a guy who's never driven a commercial truck in his life, but I mean, I've watched it happen. It's just not as easy, and it's going to take some figuring out. And we're not even to the figuring it out point yet.
Yeah. And one of the catalysts, Ken, is going to be the California regulation that all trucks working on and off the ports have to be electric. But I think it's 2030 was the cut. I could be wrong on that date, but I think that's going to be a catalyst to Ned's point.
Yeah.
There's going to be some push come from a regulatory perspective regionally.
Yeah, and I think electric's great. I mean, it's going to happen. Yeah. It's just, I think diesel hit like a 7.5-year high today.
Yeah.
When EIA updated this morning, they update every Tuesday morning, right? Still. Yeah. So all of those pressures are pushing us towards electric. It's just like, we have to get there. Let's just not, let's just not pretend that we're there yet, is I guess our point. All right, a couple more.
Juan Camilo Vergara. Hey guys, how do you filter the reports of rates from your companies? How do you know that it's good and trustful information?
How do we know that it's good and trustful information?
Like,
so there's a 2-point. I can't go into detail about this. We should do a refresher on this because it comes up a lot. So there's 3 big things at play. that help us. One, we've been doing it for, well, there might be four. I'll count it up when I'm done. It's not even preconceived. There's a couple.
Right.
We've been doing this for a long time. So we have a pretty good knack. We're always looking at it. We have teams. We have a huge team at this point who's constantly hunting and pecking at the data. And the counterpoint is we have a lot of customers, and they tell us, we had like a Houston to something mileage discrepancy the other week that there's like a needle in the haystack that someone found. So between taking a look at it, doing it a while, and our customers looking at it, that's one way. Two, when a new customer sets up contributions, we very thoroughly vet the initial files that come in and then check in with them for the first few weeks and months before we sort of take the training wheels off. That's another part of it. Third is we have a lot of algorithmic scrubbers that say, hey, 5 cents a mile was a fat finger in a TMS. We're not going to include that. Neither are we going to include $50 a mile. That's another part of it. And then lastly, we have $120 billion worth of annualized data. Would I sign on an affidavit, like under penalty of death, that all 120 billion is the most accurate? Like everyone can be audited back to a perfectly clean freight bill with a signed POD? No. You're going to have some slop. Now, do I think I have no idea what the actual number is, right? Because we're only as good as the information we're given at times. But having that much data allows to have some of that slop at the edges and not impact the core number. Right, small little upstarts, little venture capital backed firms that are just getting into rating and they have their little cute thing they're working on. Sure, when you have a dozen contributors, you have Atlanta to Chicago nailed down, but you might not have Reno to Plano. We have Reno to Plano licked. We might be a little sketch in Bismarck to Overland Park, Kansas. So that's kind of like where density is king in freight.
Yep.
No matter what, if you're doing network analysis, if you're doing fleet management, if you're doing fleet optimization, if you're doing any of these analyses, fleet data density is king. Same way shipment density is for a big carrier. So I hope that helps. We'll put that on our note pile for another show.
Yeah. One other thing, just to add,
that was kind of a quick overview.
I had one other quick thing to add, and that is the specific algorithm that we use for aggregating transactions also helps with this, so that we have we're not just like lumping everything together in a big pot and averaging it. For sure. Yeah. So again, we
need a nice little infographic of how a rate P rate becomes a rate P rate. All right, I'm deeply terrified of our head of communications, and she knows largely where I filmed this, so I'm going to cut this short. Dean, we're going to skip his shout outs. He's on all of his regular XM coast to coast type stuff. We're going to have some really great guests this month and next. And with that, I am going to sign us off because we're running long. I hope everyone has a great week. I hope you stay safe. I hope you stay warm. And with all luck, I will see you guys next week at 10 a.m. Eastern. Bye, everyone.
Bye.